Hi, my name is Jerry Yu, the Family Money Doctor. I'm glad you can join us today. And today we'll be talking about the 3 P's in estate planning. When most people envision estate planning, they often imagine a fluent individual packed in a boardroom and consulting with the financial experts, lawyers, and CPAs. But today, I wanted to dispel this notion that estate planning is exclusively for the wealthy. Regardless of your financial standing, crafting an estate plan is a crucial step in securing your legacy and ensuring a smooth transition of your assets to your loved ones. Estate planning, simply put, is determining how an individual's assets will be preserved, managed, and distributed after death or in the event that they become incapacitated. Everyone watching this video has an estate. Today we'll be reviewing the following. What are some of the 2024 estate planning opportunities? What are the 3 P's of estate planning, and what are some of considerations to make when planning for your estate? First, let's review the 2024 estate planning opportunities. Who owes the estate taxes? See, every individual has their own lifetime unified credit exemptions, allowing them to pass a specific amount tax-free to anyone during their lifetime or at death. See, there are some exceptions, such as unlimited marital deductions, which allow married couples to transfer assets to each other without using their exemptions. Additionally, there is an annual gift exclusion which allows individuals to give a set amount to as many people as they wish without affecting their exemptions. For 2024, the annual exclusion is $18,000 a person. And married couples can also combine their exemption through a process of electing portability on their estate tax return and allowing their surviving spouse to potentially double their exemptions. The estate tax rate itself varies depending on your taxable estate value, starting at 18%, reaching all the way to 40% for those amounts exceeding $1 million. But truth be told, many households will continue not to have an estate tax issue after the sunset in 2025. So with approximately $7 million per person in exemption instead of the $13.61 million per person, which is a significant decrease. But regardless the exemption dollar amount, looking at the historical trend, it will still only impact about 1% of the household per year. However, for our high net worth individual, 2024 and 2025 presents estate planning opportunities to leverage the expanded exemption before that window closes. The IRS has indicated that there are no penalties for individuals using their expanded exemptions before sunset, so really making it a use it or lose it situation. By making strategic moves like gifting assets or establishing a specific trust, individual can shield significant assets from future estate taxes. For individuals with the liquidity to do so, taking advantage of the expanded exemption will save almost $3 million in future estate taxes, which is the difference between the 2024 exemption of $13.61 million and the projected post-sunset exemption of $7 million, and times a 40% estate tax rate. Looking at your financial outlook now and run a scenario analysis to see if some certain estate plan moves make sense today. Now let's take a look at the 3 P's of estate planning. There are 2 initial primary considerations when it comes to estate planning, which are the property and people, the first 2 P's. With property, in order to pass your property to the people you want to receive it, you first must know what you have. There are several ways to get a handle on your property and calculate your gross estate. And one of these is by updating your financial statements semi-annually. If you own real estate or investment, you know these values can fluctuate rapidly for better or for worse. An updated financial statement will give you an accurate picture of your property and investment value as well as your debt. Also, take physical inventory. Your tangible personal property like jewelry, collectibles, and vehicles. They will either have a cash value or sentimental value to someone when you pass away. And an inventory will help make it easier for your heir to identify the property and whom it's intended for at that difficult time. And once you have identified what you possess, you now must consider who you want to receive your estate, or at least part of your estate when you die, which takes us to the second P, the people. Now, these are not always easy decisions to make, but particularly when it comes down to possessions that have deep and personal meanings to you. But to help people you care about receiving what you wanted to give them, having a will or a trust in place will really do two things for your heirs or the loved ones. It can help you to avoid a probate. Without wills and trust, your estate might have to go through a process called probate. The probate process will, one, make the financial affairs public, and two, delay your heirs from receiving their inheritance, and three, cost them potentially a small fortune in attorney fees. Having a will or trust can also help you avoid any family conflict. Specifying who gets what in the form of designated beneficiaries reduces the probability of discord between your family members. So this means your property and assets will be distributed according to your wishes and not whatever family member gets there first. So now that you have considered the first two P's, the property and people, now you must consider the third one, which is protection. Your property and people in your life needs to be protected against a few risks, namely taxes like federal and state income taxes and estate tax, along with the big one, which is lifestyle damage. See, this is where life insurance can be a tremendous tool in your overall estate planning, because life insurance prevents these enemies from really gaining a foothold. After you have completed your estate plan and directed how you want your property and other assets to be distributed, there is one other entity that must be considered, which is your tax liability. If your taxable estate exceeds a certain value and your heir may need to pay estate taxes or an inheritance tax at the federal and state level. See, when you think about that, there's really only three ways to pay for these estate taxes. They can either, one, pay in cash, which may not be possible for many families because once that money is gone, it's gone forever. And two, you can either sell some assets like your home or other assets to gain the liquidity to pay for those taxes. And this is not ideal for families with businesses. Or three, you can purchase life insurance to pay any taxes due. In most cases, this is the least expensive of the three options. Because if you have done your estate planning properly, your beneficiary will receive that policy that's benefit tax-free. In some cases, depending on the value of your estate, it might make sense to create an irrevocable life insurance trust, also known as ILIT, because this creates an exemption and removes that policy as being accounted towards your estate. And you will likely want to talk to your financial advisor to see if an ILIT makes sense for your estate planning. Life insurance, though, really protects against that lifestyle damage. This is the biggest adversaries and concern for people doing estate planning. When you add up these assets, you will see the value of these assets won't sustain the lifestyle for your survivors and in the manner that they are used to. Of course, you also need to consider final expenses and health care and funeral costs. If you're still working while you do estate plan, you will see that the biggest asset is your future earnings. Let's take an example. If you earn $100,000 a year and you have 25 years left before you retire, those future earnings are worth $2.5 million and not taking into account any future increases. Having enough life insurance in place for the payout to replace that income will safeguard your family's lifestyle. They will be able to continue to stay in the same home if they want and pay for children's education and pay for those medical expenses and help them enjoy life without financial stress. Now becomes a question, which type of life insurance do I need? This really is the two biggest hurdles for people buying life insurance. I again encourage you to reach out to your advisor or your life insurance agent to determine your unique situation. There are two main types of life insurance. There is term insurance, which a lot of people are familiar with. This is an agreement with the life insurance company to cover the policyholder for a set number of years. The most common is the 10-year term, and this insurance provides a death benefit only without any cash value. It tends to be the most affordable, more so than permanent life insurance, and can be a little bit more budget-friendly. Those premiums remain level throughout the duration of the term period, but the premium can increase if you wanted to renew to another term later on. The second is permanent life insurance, especially index universal life, which is known as cash value life insurance. This is a form of a coverage that covers the policyholder their entire life. It combines the death benefit with cash value accumulation. With an index universal life, your policy follows the growth of a specific index by which your cash value can grow over time. And premiums remain flexible, but this type of insurance is more expensive than term insurance, but offers cash value growth, tax-free distributions, and most importantly, a tax-free death benefit upon your passing. And lastly, let's review some of the basic considerations when preparing your estate plan. If you get nothing else out of it from this episode today, but I encourage you to do at least those three things. First, draft a will. A will is a fundamental document that outlines how you want your assets to be distributed after your death. You want to clearly state who should inherit specific assets and designate an executor to carry out your wishes. And if you have minor children, appoint a guardian to take care of them in the event of your demise. And this is something that you are going to want to regularly review and update to reflect any changes in your circumstances. And two is choose beneficiary designations. Ensure that your beneficiary designations on accounts such as life insurance policies, retirement accounts, and bank accounts are all up to date. And clearly specify primary and contingent beneficiaries for each of these accounts and keep those designations consistent among your overall estate planning goals. And lastly, assign your healthcare directive. Creating a healthcare directive such as a living will or healthcare power of attorney to communicate your medical treatment preferences. And you can designate someone who you really trust to make medical decisions on your behalf if you ever unable to do so. And share some of these documents with your healthcare providers and family members, ensuring what they're aware and what your wishes are. And in conclusion, your financial legacy really starts here. When you think about it, your financial legacy is a personal narrative, and crafting a plan that aligns with your aspiration is your financial team's commitment to you, whether that's through a personal consultation or online research that you may do. See, your team is here to guide you towards the secure and empowered financial future. So let's start shaping your legacy together. And thank you very much for watching today, and we will see you next time. Thank you.